Are you looking to purchase and finance a home with a steep price tag? Well, then you may be in need of a jumbo loan product. Jumbo loans are used for home purchases that are higher than your county's conforming loan limit, which we'll cover in a moment. And they have some key differences compared to conventional loans. My name's Nicole Rueth, SVP of the Rueth team and the #1 loan originator in the state of Colorado. And before we dive too deep into the good stuff, if you enjoy this video, make sure to give it a thumbs up and subscribe to my channel. Both jumbo and conventional loans require homeowners to meet certain eligibility requirements, including minimum credit scores, income thresholds, repayment ability, and down payments. They are both non-government sponsored programs as opposed to FHA, VA, and USDA. Although they may serve the same purpose to secure a property, jumbo mortgages are loans intended for financing higher priced homes. Essentially, they involve bigger sums, $726,200 at least, and often running into the millions. So those beautiful luxury homes and those found in highly competitive local real estate markets are generally financed using jumbo mortgages. Jumbo mortgages are also non-conforming. That means they fall outside the Federal Housing Finance Agency or FHFA restrictions on loan sizes and values, and are therefore restricted from receiving backing from Fannie Mae and Freddie Mac. They also exceed the maximum conforming loan limit in their respective counties. Conforming loan limits are adjusted annually to keep pace with the average U.S. home price. So when prices increase, loan limits increase, typically by a similar percentage as well. And in some counties, where home prices are much higher than the averages, there is a high balance loan limit. For example, Denver County's high balance loan limit is $787,250. So anything above that amount would be considered a jumbo loan. So depending on where you live, your high balance loan limit can be different. In order to qualify for a jumbo loan, borrowers must have excellent credit scores, and they tend to be in higher income brackets. Considering the higher costs associated with higher priced homes, this makes sense. Lending requirements have also become tighter following the financial crisis, paying particular attention to debt-to-income ratios, reserves, and ample credit history. Because jumbo loans are not backed by federal agencies, lenders are taking on more risk when they offer them, which is why borrowers face more stringent requirements when getting qualified. Although there are exceptions to every rule, the first thing you'll need is proof of income. You'll typically need 2 years' worth of tax documentation to prove that you have a reliable, consistent source of income. Lenders will also want to see you have enough in liquid assets on hand to cover 6 months' worth of mortgage payments or more. Second is your credit history and score. In jumbo loan cases, the higher, the better. Lenders tend to look for credit scores of 700 or better. If you're not quite there, don't worry. Here at the Rueth team, we have a credit repair and optimization services available to help you on the right path. Thirdly, lenders are going to look at your debt to income ratio or your monthly debt obligations compared to your monthly income. This should be no more than 43 to 45% to qualify for a conventional mortgage. However, lenders typically look for an even lower debt to income ratio on jumbo mortgages, typically at the most 43% and even ideally at 36% or less, because the loans are larger. The fourth thing that you want to look at is the loan to value. It needs to be typically 80%, sometimes as high as 90% or lower. This means that the loan can finance no more than 90% of the purchase price of the property. Last but not least is sourcing your down payment. Due to the loan to value requirements, you will likely need to bring at least 10, if not 20% as a down payment, and you will need to have those funds in your personal bank accounts. So to wrap things up, jumbo loans are more restrictive because the bank is loaning you more money. I mean, they're taking more risk. However, like everything else, there are exceptions. Low down payment, asset-based loans, using gift funds, lower credit, lack of reserves, and higher debt-to-income ratios all have solutions. They might just come with higher interest rates. Well, that's a wrap for today's video. If you have any questions or if you'd like to get your home buying journey started, please do not hesitate to give my team a call. We'd be honored to serve you.